Good evening, ladies and gentlemen. Oh, excuse me. 女士们、先生们，晚上好，欢迎你们来。Tonight, what I want to talk about is the three essentials that we need to look at in terms of trading and investing. Now, we tend to think that the trading techniques and the investing techniques are different. Some of them certainly are. But there are also important methods or important points where they are very, very similar. Now, most of you have watched, I hope, the IG Markets Apprentice Asia show that was on a couple of weeks ago, or a couple of days ago actually. So what we want to do is we want to focus on what was used in those techniques and how we can apply them both in a trading environment and an investing environment. So there are three things that I really want to cover tonight. There are three elements. First of all is using chart patterns to help us define risk and reward. Now there can be large-scale chart patterns. Chris talked about a head and shoulders pattern on the Australian-New Zealand dollar cross. That's a long-term investing pattern, but they also appear on short-term patterns. I want to talk about identifying trend breaks and rebound and trend continuations. In other words, when is this current downtrend in the STI going to end and turn to an uptrend? Because if we can identify that, then we can make some more money as it's going up and close all of our short positions. And finally, I want to look at some ways that we can set both our entry and our stop loss conditions. Because it doesn't matter how much research we've done. It doesn't matter how much fundamental research, how much technical research we've done. There's always this wonderful opportunity to buy a stock and make a big, big mistake. And we've got to know exactly when we make that mistake. So setting stop loss and entry conditions is part of it. So that's three things I want to cover this evening. At the end of this, you're welcome to ask questions both of myself and of Chris, and what we'll try to do is bring it together so that you can see how these sorts of methods all combine to give you better investing and better trading results. So the first thing I want to look at is what's called chart patterns. And chart patterns, unfortunately, they're very, very good, but you either get it or you don't. One of the advantages of chart patterns is, first of all, they capture market behaviour. If you look at these chart patterns on an index in 2007, come November, January, you knew well in advance that the market was likely to collapse, number one, and number two, it was going to collapse quite dramatically. So you were selling your investments, you were selling your positions, going to cash, ready for that fall in the market. They're also used to calculate price targets, what's called measured moves. So that means that you know you can buy here and it's likely to go to this point. Or you can sell here and it's likely to come to this point here. Take some of the guesswork out of what happens in the markets. And that allows us to calculate exact risk and reward ratios. I always want to get preferably at least $3 back for every $1 that I'm putting into the market. Chart patterns develop because they are our personal behaviour extrapolated across the market. In other words, lots of people think exactly the same way as we do. We all look at the same information. We all look at the same charts. Most of us don't get to play golf with the CEO of a company. We don't get any advanced information on what's going to happen. So we're all rolling off pretty much the same information. But what we see and how we do it, we can understand the broader market, and that gives us an advantage. But pattern recognition is a skill. It's an art. I really like it, but I also recognise that a lot of people find it very, very difficult. So, for example, what I want you to do, I want you to look at this next picture and tell me what you see in it. What's in the picture? What's it a picture of? How many people can see the face, the large face that's in the picture? Please indicate. Yeah, that's about average. About 1/3 of people. Now, for those of you who can't, that's what it looks like. There it is. Once you see it, you can't stop seeing it. When you first look at the picture, for 2/3 of you, all you see are these women here and here, this figure here and this one here. You don't see his face. That's one of the problems with pattern recognition on a chart. Once someone just shows you what to look for, you never miss it again. And because patterns give you such a powerful way to understand and interpret the market, I want to spend just a little time on one of the patterns. Now, this is what we tried to teach the participants in Apprentice Asia. I'm sure that you're going to be much better students than they were. Pattern basics require accurate support and resistance lines and accurate trend lines. An accurate support and resistance line is a horizontal line that's drawn on a chart. It's where price tends to stop all the time, on the way up or on the way down. It's like a floor and a roof. Whereas a trend line defines a changing level of support or a changing level of resistance. Support in an uptrend, resistance in a downtrend. But the problem is that when we use a chart package, and most of us do these days, a lot of chart packages deceive us into putting support and resistance lines in the wrong spots. Look at these lines here. Are those lines horizontal? No, they're definitely not horizontal. No way they're horizontal. Unfortunately, they are. These are all horizontal parallel lines. What has happened is that the background information on this screen here has deceived your eyes into thinking that in fact they're not horizontal. Why is it important on a chart? Because when you use charting software that has a grid on the back, your eyes will automatically put the support and resistance lines where the grid lines are. And they might bear no relationship at all to where the genuine support is in the market. They act as a guidepost. So when using a chart, and all the charts you'll see tonight, they do not have grid lines on them for exactly that reason. I want to be able to accurately place support and resistance because that's an essential part of how we establish where the chart and chart patterns are. So, trend lines. Trend lines are really simple. Trend lines help us to define whether it's moving up or moving down. This is NYMEX oil, a little bit while ago, and this was described by one of the major news wire services as a clean break of a key downtrend. Who would agree? Please indicate. And remember, if you get it wrong tonight, it's no problem. You're not going to lose any money. A clean break of a key downtrend line. Is this an accurate analysis of that chart? Does that put the trend line correctly in place? Who says yes? Who says no? Who's waiting for me to tell you the answer? Okay. It's a total... Okay. When we use a trend line, obviously we start from, in this case a downtrend, the high point. But what we're looking for is for a test of that line. That was a rally and a retreat that must take place preferably on at least 3 occasions. 2 is okay, 3 is better. So this line has a touch point here, number 1, number 2, and not here because it breaks through. If we use that criteria, then we can also place all of these trend lines on the chart. Just take that out of my pocket. And what we see there is that this line has 1 point, 2 points, 1 point, 2 point. They're all exactly the same. There's only one valid trend line on this chart. That's from this point here, 1, 2, 3, there's the breakout. And if they'd got that breakout at $40, by the time the news service said this is an important change in the trend, they had already made 100% because the breakout took place at $80. So putting an accurate trend line on a chart is very, very important. Key points, a starting point, and at least 2 other anchor points to be able to connect the line. So horizontal lines pick up where price moves to a roof and pulls away. Moves to a roof, pulls away, pulls away, pulls away. Usually 3 or 4 times gives us some confidence that that support resistance line is placed accurately. Same on the floor. Hits that, bounces away. Hits it, bounces away. Hits, bounces away. Bring these 2 together and we have one of the most useful and powerful patterns in the market. Now by useful and powerful I mean you see it relatively often and it's reliable. By reliable what I mean is that when the pattern begins to develop there's a high probability it will hit its upside targets. That's a key factor. That means I can trade it with confidence. And it's not just on short-term charts. It's not just on 10-minute charts or one-day charts. It's on weekly charts and it's on monthly charts. And it behaves or gives the same messages. So we start off by accurately drawing a resistance level. This is accurate. Here's our first point. Second, third, fourth, fifth, sixth. This has been hit many times and the market reacts away from it. So the first step is drawing an accurate resistance level, or a support level as the case may be. We're going to trade from the long side, so we'll call it resistance in this instance. Then we need to be able to accurately place an upsloping trend line. And what we're looking for in an upsloping trend line is at least 3 anchor points. A starting point, a second anchor point, and a third anchor point that define the limits of how far price is pushing down. And in this chart, this is where we do it. From here, point 1, point 2, point 3, 4, 5 and 6. That tells us excuse me, that there is a high probability that this trend line is accurately placed, and that means that if we get a close below this trend line, then this pattern finishes. If we get a close above this resistance line, it confirms the pattern and it allows us to estimate fairly reliably how high that price movement is likely to go. For me, that's worth money. And if it's worth money in the market, that's where I want to be. But how do we work out how high it's going to go? Why do we start here and not here? Or even here? And there's a very important reason. For this pattern to be valid, then it must be as close to the ideal pattern as possible. So we must understand what the ideal pattern looks like. So if I said to you, look, I'm thinking of an animal. It has 4 legs and a tail and it barks. What animal am I thinking of? Anyone like to have a guess? A dog. 4 legs, a tail, and it barks. Sorry, I'm thinking of a crocodile. Crocodiles bark as well. Now, if I told you it lived in water, then you wouldn't say a dog, you'd say probably a crocodile, if you knew crocodiles bark. Point, the more accurate the definition, the less likely you are to be eaten. In the market, the more accurate the definition, if I'm buying in here, then there's a high probability this will develop as required. So what I need for a triangle pattern, upward sloping, downward sloping, or equilateral, is a triangle base. And that is 1 to 5 days of price activity that is moving pretty much in the same direction. In other words, 4 out of 5 candles are green, or 3 out of 3 candles are green, or just 1 large candle is green. This is the base of the triangle. No base, no triangle, no pattern. Wave goodbye to your money. You take the base and project it upwards. That gives you the upside target. There is a high probability that when price breaks out of this pattern, it will reach this target level. That means I can buy in here with confidence that we're going to get this sort of target. In a bull market, this happens about 85% of the time. In a bear market, this is successful about 70% of the time. So in a bull market, I want to trade upsloping triangles. And if I enter in here or here or here, my stop loss is the value of this trend line. If I enter close to this trend line, my stop is very tight, very small. But the advantage is I get the maximum sort of return from that pattern development. And that's particularly useful. We can have what's called a hanging start. And we see this to some extent in some of our recent bull markets. And that is, we start first of all always with the horizontal support resistance level. But in this case, there's been several days that have moved above that level and come back. Now this horizontal support resistance, if we use the longer term chart, we might find in fact that this is confirmed on a weekly chart as well. But we can clearly see 1, 2, 3, so it's quite clear that this is the correct placement of the trend line as this pattern develops here. So where's the base? The base in this case is created by 1, 2, basically 2.5 days of price activity from here to here. This gap between this bar here or this candle and this candle is part of that pattern. So there's a solid move up here. That's our base. Measure that, project it upwards above this upper level here, and that gives you the upside target. If there is no base, there is no triangle. If there is no triangle, there is no pattern. If there is no pattern, there's no money. This is what it looks like in real life. That was a perfect example before. This is a chart that I've traded. Resistance level. Now we had a downtrend sitting through here, but then we had several days where we established this resistance level and a false breakout here. Our trend line, yeah, we ignored these 2 days here because by using it through here, grabbing most of the price action here and through here, this is a sensible placement for that trend line. Our base was created by 1 day of price activity. This is our upside target. Now, where do we get out? Because our upside target is here. This day it goes to here. The next day it goes to here. So what do? We get the calculator and go, okay, I entered here and it's gone to here and I was going to get 15.5% out of that, but if it goes to there I can get 20, and if it goes to there I can get 25, and it looks like it could go to 30, so I'll hang on to it. Not a good idea, because when these patterns collapse, they can collapse quite rapidly. So it fell back to here, and you thought, no, I should have got out. I should have got out. Oh, no, it's closed higher. I'd made the right decision. I will stay in, I will stay in. Yeah, right, okay. This stock is for my grandchildren by the time it gets to there. So the key factor with patterns, yes, they will reach their targets, but once they reach their targets, they are not what's called continuity patterns. In other words, they won't continue on to something else. They are traded just purely and simply by themselves. And they occur in multiple time frames. In other words, if we're trading a 1 minute chart, which I haven't got sitting there, then you see the same pattern traded in the same way. If each candle here is a daily candle, trade it in the same way. If this is a weekly candle, analyse and trade in exactly the same way. Now, Chris was talking before about head and shoulder patterns. From an investment perspective, some of these patterns give us a long-term advantage in the market. So, for instance, one of my favourite ones is a head and shoulder pattern. And those of you who read my column in The Edge on Friday understand you've got to believe the charts. Look at this. Here's the shoulder, here's the head, here's the shoulder. The market's trading nearly up at 5,000. There's a neckline, in other words, it connects the bottom of the shoulder through there. You take the head to there, project it downwards. There's our downside target. And you're trading up here. And you're saying, there's no way that this is going to be achieved. Maybe I'll take a few short positions, but it's just not possible for the market to collapse from here, to go from 5,000 or 6,200 down to 2,700. When in doubt, as Chris said, believe the charts. That's Shanghai Index. But you can do exactly the same with the Dow Jones. S&P, there's Dow Jones for you. Downside target again achieved and exceeded. So, patterns are particularly important. This is ANZ on a 1 minute chart, triangle, measured and used in exactly the same way. And this isn't actually the stock, this isn't the screen that's supposed to be up and running at this point in time, but it doesn't matter. Okay, so patterns give us one way of trading the market. Not everyone is comfortable with it. What we really want to try and do in most of our investing or trading is understand when a downtrend is finished and about to change to an uptrend, or when an uptrend is finished and about to change to a downtrend. So we're looking for trend breaks, down to up to down, or trend continuation. So is the pullback in the STI at the moment a change in trend, or is it part of just a retracement within an existing uptrend that's going to continue? In other words, should we be buying in the next few days, or should we be continuing to sell? How do we understand the difference? For me, the key information I want comes from moving averages. Now, people will often talk about using two moving averages. Here I've got a 10 and 30-day exponential moving average, and they say when the 10-day moving average crosses the 30-day moving average, the market's going to go up. Or we can develop a golden cross. A golden cross is a wonderful thing. It has three moving averages. And what happens is you lose a lot of gold and you get very cross when it's wrong. Doesn't help us. Moving averages in themselves don't tell us enough about the information. Here's a moving average crossover. That's successful. What about this one? Didn't work. This one didn't work. So how do we know the difference between this one and this one? To do that, what we have to do is understand some of the structure of the market. Now, I use a Guppy multiple moving average combination. You saw this the other night if you're watching Apprentice Asia. Because the two most powerful groups in the market are traders and investors. Traders are young, successful, and have lots of money. Investors are old, slow, and have lost a lot of money. They're the longer term group. Slower to act. So we've got a trend line through here. Same as we're using on those patterns before. And we've got a close above here. Is this a genuine break of the trend? Don't really know. But what I do know is that traders are more aggressive. They'll come into the market and they're always trying to find out if it's going up. They keep on testing. If they make a mistake, they get out very quickly. Investors, a little bit slower to reach the same sorts of conclusions. So by using two groups of moving averages, I understand the inferred behaviour of traders, short term, and investors. And to understand the traders, I use a combination of moving averages. Before I go to there, it captures the change in opinion and the change in strength that's taking place. And we do that by looking at the degree of compression in each of the groups of averages. When they compress, they tell us people are in agreement. When they are expanded, they tell us people are in disagreement. And when the two groups are separated, it tells us that, in this case, traders are very optimistic about the stock and investors are becoming increasingly optimistic. So it's safer and safer to buy in here for a continuation of the trend. When both groups combine and compress, when both groups agree, it tells us there is a very high probability of a major change taking place in the trend. So, how do we all reach our decision about what stock or index or currency to buy? We don't live in a HDB flat, halfway between floor 13 and floor 15, where the lift stops at the wrong floor. We don't sit there without TV, without radio, without a handphone. Our opinions about a stock or an index or the market are formed by many, many different factors. Stock advisory sheets to clients, fundamental analysis, technical analysis scanning, market reports from CNBC. You can catch me on Wednesday morning, by the way, on Squawk Box. Popular investment magazines, brokerage reports from IG Markets. We're all working with exactly the same information. So not surprisingly, you get all of these reports and they all reach pretty much the same conclusion about the stock or the index. Most of them. And they say, this is worth buying at $7.50. So, how do traders think about that? Remember? And we track them with a 3, 5, 8, 10, 12 and 15 exponential moving average. $7.50. You believe me that this stock is really worth buying at $7.50? You don't buy it tomorrow, you're going to miss out on the fortune that's going to recover all your losses from 2008, 9 and 10 combined. Believe me, trust me, I'm a trader. $7.50. Who's going to buy this stock at $7.50 tomorrow? Please indicate. Oh, I can see you're investors. Okay. Who'd be prepared to pay $7.55, $7.60 to get the stock? Remember, you can make as many mistakes as you want tonight, you're not going to lose money. Who would prefer to wait for the stock to come back maybe to $7.40 before you buy it? Okay. You're the people who go to Geelong because it's about 10 cents cheaper in Geelong to buy stuff than it is in Singapore, even though you can only go with half a tank of fuel. The bargain hunters, even though we have the same information, we all agree it's worth buying, but we'll buy at different sorts of price levels. Some will buy it if it's a little bit cheaper, some will buy at the exact price, some will buy it when it's a bit more expensive. We get compression. Investors behave in the same way, except that they are slower. And we use 30, 35, 40, 45, 50 and 60 moving averages, exponential, to track their behaviour. Now investors, they're different people. I mean, I'm a trader. When I decide to buy a stock, the only person I have to tell is my wife, eventually. Doesn't have to know immediately. If it's successful, I'll tell her. If not, you know, it doesn't need to know that information. But if I'm an investor, I've probably got a committee I've got to talk to. I've got to go and convince other people to buy it. We should be buying this. We should be buying Keppel Corp. We must be there. That's a week or 10 days, all the rest of it. Not good. So what happens is that although they reach the same information, the same conclusion, they take a bit longer. And what we get is compression, this agreement, across different time frames. Because when investors come into the market, they've got to move in much larger size, more difficult to execute. So this gives us the advantage. It tells us, here's our downtrend line. We're not too sure whether this breakout is genuine, it's going to keep on going up, or whether it's false. GMMA analysis tells us in this period, traders agree about price and value. They start to come into the market. You can see the compression and then the expansion. And a little bit later, we see that investors also come in. We see that first of all they turn up, the bands narrow. When it narrows, it means there's agreement about price and value. This is a good stock at this price. It's correctly valued. Remember Warren Buffett? I don't really know him, but I'm sure that you've got a better relationship with him than I have. He says buy good companies at good value. Underpriced, in other words. And that's what the investors are trying to do. So they're deciding here, this is a good company at a reasonable price. This is the agreement point. So when you get agreement between traders and investors, there's a high probability that this trend change is confirmed. Does it matter if you get in at $7.60 or at $8.50? No, it doesn't. If you're a trader, it does. But if you're an investor, it doesn't. From an investment perspective, you want some greater certainty that this trend is likely to continue for 4 or 5 weeks or several months or hopefully for several years, just keep on going up. So we're not trying to get the very bottom. We're trying to get somewhere in here because there's a higher probability that this is going to continue moving upwards. Don't know how high it's going to go, but we can be fairly confident that it's going to move in that direction. That's what we're trying to do. So, by bringing these two groups together, we get a variety of different analysis techniques and methods. The red group, long-term investors. The blue group, short-term traders. Now, this could be that every candle represents 1 day. It could be that every candle represents 1 minute. It could be that every candle represents 1 week. The analysis methods and conclusions are exactly the same. It's called fractional repetition, which is really exciting because it's a great way to make money. So what it tells us, let's say I'm a trader. I see this first attempt here. It's a breakout test. I don't trade this. It's unlikely to succeed because this long-term group is widely separated. It tells me as soon as price goes up, investors are likely to be selling down into it, pushing the price down. So not much chance of success here. Then we get another breakout test and we get a move above this level. Now it may be a break of a trend line as well, but notice that the long-term group in this area has begun to compress. Some of the investors have stopped selling. They're not buyers, but they're not sellers. So that's showing up as compression in that long-term group. So I can buy this breakout with a reasonable degree of confidence that this is likely to continue. Not 100%, but a reasonable degree of confidence. I can buy a breakout retest. In other words, price has gone up, it comes back, retests the long-term group, and then moves up again. It doesn't move below this. This tells us that this change here, that investors have come into the market as buyers. Here, they stop selling. That shows by that compression. This expansion that begins to take place shows us investors are coming in as buyers. As price comes down, they say, this is an opportunity for a long-term position. So as a trader, I can buy in here with a lot of confidence that this is likely to continue upwards. As an investor, I can also buy in here with confidence that that's likely to continue moving up in the longer term. So we use it to understand the behaviour of other groups. Here's a longer term chart. This is, I can't remember what this one is, but it was very profitable. Very long, solid, straight. All the investors just supporting this trend. Wonderful people. I love investors. Without you, I can't make any money. I need a safety cushion underneath so that when price comes back here, I can very, very safely enter into this trend because you're going to protect me. You're like an airbag on a car. I'm not going to crash. I know there's a high probability of a rebound. Back in here, here's another opportunity. You just come and give me money. Thank you, thank you. Go and say it, go and say it. I'm into here. Same here. Am I worried about buying in here? No, not at all. Because this separation here tells me that investors are still buyers. They're not sellers. All the way through here. Eventually, this long-term group begins to compress. Once it starts to compress, it tells me that some investors are becoming sellers. So when you get this pullback here, there's less chance of it continuing to bounce and continue. Now, if you're an investor, you have two questions. The first question is, you're an investor. Why didn't I buy here when it was quite clear that this trend? Why didn't I buy here? That's the second question. Because this chart has been available for everyone to see for the last 3 or 4 years. And it tells you very clearly that there was strong investment support for this particular stock. You could buy anywhere in this period and ride this from about $56 through to about $74. This is not an antidote to insomnia. You're not going to lie awake at night worrying about what's happening with this stock. You can sleep easily. It's a good, solid underlying trend, and you know this because of that long-term group is widely separated that tells us it has long-term investment support. It's a key factor. So, we've decided this thing's going up in the long term. How do we decide how to enter? Now, if you're really adventurous, what you simply do is you say, yes, I'm going to buy this stock. And you ring up your broker and say, buy. I don't care what price I pay, just buy. And then you go out and you go bungee jumping or jump out of aeroplanes with parachutes and so on. Don't know. That's a very risky way of doing things. What I prefer to do is say, yes, this is a trend breakout or this is a mid-trend entry. I want to buy, but I want to buy at a price that allows me to manage my risk. Because the first thing I know from experience is that just when I'm feeling most confident in the market, that's the time when I'm most likely to be absolutely wrong. And it doesn't matter what I do. Eventually my wife finds out. And I don't really want that to happen. So I've got to set a stop loss. And the understanding of an idea of a stop loss or protect profit, a stop loss is designed to tell us when we've made a mistake. It's got nothing else to do. It simply tells us, you didn't do the analysis correctly, the market's not behaving the way you thought it was, you've made a mistake, get out now before you lose your grandchildren's inheritance. Remember, no one says you buy here and you have to hold on all the way down to here. You can get out. It's simple. Click the mouse button, sell. Ring the broker, sell. Get someone else to do it for you. Go to your partner and say, I'm sorry, I just lost $1,000 today in the last 30 seconds. Can you do something? She'll sell it for you. That's no problems. Get out. You don't have to stay in. The stop loss helps you to define when you've made a mistake. Now, I use what's called a Guppy countback line. And it defines the trend behaviour using price volatility. Let's not get too complicated about all of this. What it boils down to is simple. What I want to know, first of all, is how much movement is normal. Remember the good old days? That's before 2007. Good old days, you'd look at the market, and if the market moved, the Dow Jones index moved 3% overnight, then the first thing you did is you make sure that every window and every tall building was locked. Because otherwise people would be jumping out because 3% was so volatile. Now, 3%, no one's worried about it. We can see 4, 5, 6% overnight moves. Not a problem. So what I want to know, for any stock or index, how much movement is normal? This is okay. How much is abnormal? When do I need to worry? When do my knuckles need to go white on this particular ride? Countback line helps me to do that. So first of all, I've got a downtrend line in place. What I'm looking for is a close above the downtrend line. That's usually a bit of an indication that the trend may be changing. Problem is, too many false signals. Now this applies both to traders and to investors. We may have that 10 and 30 day or triple average moving average crossover. Also, too many false signals. False signal means it says walk, but unfortunately the signal for the truck doesn't say stop and you get run over. So you want confirmation. You want confidence the signal's correct. Countback line does it. So what I do is I look at the volatility over the last 3 significant periods, not 3 days. 3 days on this chart, but 3 significant periods. And what I say is that what I need is first a break above this downtrend line and then a close above this volatility bar, this countback line. And the position of this line will change depending on how the volatility changes in the market. That's why we say it's self-adjusting. And I enter on the next day. Doesn't matter what the price is, I want to get in here. So it just gives me a mechanism, a way of deciding what is a reasonable price to pay when I've decided to enter this stock as a new uptrend begins. Or this may be a situation where there's a solid uptrend in place, GMMA shows you that, and you've got a retreat that's taken place and a rebound. Where do I buy the rebound? This helps me to get in. It gives me a method to decide what is a reasonable price to pay and a higher level of guarantee that this rebound, this trend change, is likely to continue. Because you see, I'm a trader. I'm not a gambler. If I want to go to gambler, I go to MBS. Look at MBS. MBS is a monument to people who love losing money. That's what built it. It isn't built by the people's winnings, it's built by the people's losings. I don't want to take that attitude into the market. If I go to MBS and I play roulette, and I like to play roulette, my wife occasionally likes to play poker machines. When we go, I have a simple job. Not very often, thank goodness, I have a simple job. The amount of money she loses on the poker machine, I have to make back on roulette. Most times it works, but she can lose an awful lot sometimes. So I want to avoid that situation. I want to be able to control my risk. In the casino, I can't, because it's the casino operator who says, this is when you must put your bet on, and bad luck, you can't take it off until the whole thing's finished and you've lost your money. In the market, I can say, this is the point that I want to enter, and my stop loss says I get out if it comes back to here. I have total control over my entry and my exit. Can't control what the market's doing, but I can tell it when I'm going to get in and when I'm going to get out. I can decide how much money I'm going to lose. Can't decide how much money I'm going to make, but I can always decide exactly how much money I'm prepared to lose. Countback line allows me to do it. Now, only two things that happen with this. First of all, where we have equal highs, this is why it's not 3 days. Up one candle, cross to the left to the next highest candle. Ignore this one's an equal high. Up to the top of that candle, across to the left to the next one, then this is our countback line. So here, price would have to break out and close above this level before we buy. This one, this is a price gap. Top of the candle, across to the left, ignoring this candle because it's lower. High of here, across to the next candle in the current trend, and again, we'd have to get a breakout above this level before we bought into this particular stock. You might be really in love with this particular stock, but in this particular instance, you can be romantically in love with your wife, but when you're talking about a stock or an index and a currency, it's all about the money. No room for love, it's just about the money. So even if it looks really, really good, if the breakout only goes to here, it's not a buy signal. It has to move above the normal range of volatility movement in recent times to confirm it as a buy signal. And that's the purpose of using the countback line. It is used as a confirming signal. This is an example of a mid-trend entry. Now, if I showed you the GMMA underneath this, you would see that the long-term group is widely separated. So it tells us that this pullback here has a high probability of rebounding and continuing the underlying trend. Very suitable for trading, very suitable for investing. When to enter. So what I'm looking for here, there's my lowest low in the current trend. That's where my calculation point starts. Up, across the left, up again, across the left. Here's my countback line. Now, for instance, if this had been the lowest low in the current trend, at this point, to get the rest of the chart, top of the bar across the left, and our countback line would be up here. So every time a new low is made in the trend, we recalculate the countback line. But here we know this is the lowest low, sometimes called the pivot point low. Here's our CBL, countback line. Here we have a price breakout that is above the downtrend line. It's above the countback line. We only have one problem. This is an end-of-day signal. The market is closed. I can't enter until tomorrow morning. One sleepless night before Father Christmas comes. because this is an ideal opportunity. So I'm buying here on the next day. I'm not worried about whether I'm buying at this price or at this price. Once I buy here, the important factor is I don't want the price to fall below the countback line calculation. Now, as a stop loss, we take the highest high in the current trend, use this one, bottom of the bar, cross to the candle, down to the bottom of the candle, across to the next lowest candle. Here would be our stop loss. As the next high is made, same calculation. Here's our stop loss. Next high, stop loss. As it moves up, the stop loss, the trailing stop loss follows. Now, this is more suitable for traders rather than investors. From an investor perspective, you're looking at the strength of the underlying trend, and as the long-term group begins to compress, then you would be saying, okay, time to start closing my investment positions. But traders are a little bit more impatient. I just want a lot of money very quickly. I don't really want to wait too much time. So countback line is volatility based. It's not time based. It doesn't use 3 days in the calculation. That's time. What it uses is 3 significant candles. And that is those candles that are higher than the previous candles or lower than the previous candles. So here we're using it as a stop loss. So we've joined the trend down here and we're moving up. So if we take this point here, come down to here, cross to the left on the next lowest candle, cross to here, cross to the left, here's our stop loss line. So we get a close below here, we're out of the trade. Here's a new high, bottom of the candle, cross to the left to the next lowest candle, cross to the left to the next lowest candle, which is even lower than this one. Don't use this one. 5 minutes, actually. Don't use this one. Never, ever lower your stop. Because what that does, it just allows you to lose much, much more money. It doesn't actually protect your profit. So the stop always lifts up. Point 5, here we have a gap in the market. Down to the candle, cross to the left, the next lowest candle, down to here, cross to the left to the third lowest candle. In this case, 3 candles. Here's our stop loss line. Or in this case, it's actually a protect profit line because we entered down here in this underlying trend that's moving up. There's our exit point, and we get out on the next day. Does anyone here know how to exit on the close of the market? Yeah, you can't, can you? The close, by definition, is the last trade for the day. So our signal, our trading signal, our entry signal, our exit signal is the close of the market. And we execute on the next day. This can be applied to a daily chart. These candles could be 1 week candles, or they could be 1 minute candles. If we're applying it to an intraday chart, trading currencies, for instance, or indexes, then our exit would be in the following minute. This minute, here's our close, we exit on the next 1 minute. Or if it's a 10-minute chart, we exit the next 10 minutes. And of course, just because none of us like losing money. I don't mind giving money to charity, but I don't like giving money to other people in the market. I don't know them, maybe they don't deserve it. So I like to try and make sure that I get the best exit possible. So although I'm going to exit on this day, or in this 10 minutes, or in this week, I'm going to try and get the best exit price possible. But I will exit at this time. Because if I don't, the odds are that this downtrend is likely to continue. Of course, I could go short as well. And if we're going to go short, we're using the same method, but in reverse. So we're taking the top of the trend and working out where our stop loss line is. Let's say in this area here, we've got a moving average crossover, uptrend to downtrend. So what we do is we take the lowest low in the current trend to get these bars. So there's our first stop loss line. So we enter somewhere in here. As long as price doesn't move above that stop loss line, this remains a short trade. Here, exactly the same, calculated from this point, calculated from this point, calculated eventually from here, and here's our exit point on a short side trade. In both cases, what we're using is the volatility of the price move to determine where we should reasonably place a stop loss. Now, we can do a whole lot of complicated calculations, which we're not going to do in the remaining 3 minutes, that will allow us to get our exact position size, how many contracts we should buy, given our entry point and our stop loss point. Here's an example of how it uses on a protect profit. Here's our entry point through here. Downtrend ended, we've got the multiple confirmation signals, and we continue to ride this trend just simply using the count back line as a method of defining where the protect profit stop was. Once we got a close below there, that's when we got out. It captures the bulk of the trend, not the very bottom, not the very top, just the really meaty, chunky bit in the middle. You know, I'm sitting down eating chili crab. I don't really want to eat the shell on the top or the shell on the bottom. I want the meat in the middle. When I'm investing or trading, it's exactly the same thing. I don't want the hard bits at the top and the bottom. Just give me the meat in the middle. A bit of gravy on the side's okay as well. That's what we're trying to do in this situation. So, if I can summarise, and I have 2 minutes to do so, survival. We use chart patterns to define the risk and reward. If you can teach yourself to recognise chart patterns, then you'll have a whole range of trading techniques that are high reliability, low risk. Given my preference, that's what I'll always trade. When I look at a chart, the patterns just stand out. The little sign that says money available here. I just take it. But if you're not so good at identifying patterns, you have to use these other methods. Identify the trend breaks and the rebound continuation, in other words, coming down and rebounding for a trend continuation. Use the GMMA to understand what other people are telling you in the market. And use the count back line to set your entry and stop loss conditions. Exact point to get in and where your exit point is. And your maximum risk should be 2% of your total trading capital. Now, as we talked about before, I'm not a licensed investment advisor. What I've talked about tonight is purely for your education. It's a way to improve your trading on the stocks or the indices or the currencies or the crosses or the CFD trading that you want to do. Thank you very much for your time and attention, and now we'll take some questions.